Hey guys, how to trade and scan for MINERVINI volatility contraction pattern breakout setups, plus his cheat and low cheat entries. So usually the videos on this channel are very thorough, very in-depth, very in the weeds. This one I'm going to come at it from a slightly different angle. I'm actually just going to make it really easy to follow, and I'm going to show you on the next slide what it is we're going to be learning in this video. Before we do that, I'll let you know that MarketSmith are today's video sponsor. If you're interested in a discounted trial, then there is a link in the comments section below. And with all of that being said, let's just get straight into it. So what are you going to learn in this video? This is the order in which we're going to tackle it. So the 4 stages of the price cycle, you're going to learn about the neglect phase, accumulation, topping and declining. Which stage of the price cycle to trade volatility contraction patterns? What is a volatility contraction pattern? Why have volatility contraction patterns occurred for over 100 years? I've got some charts that are over 100 years old to be showing you in this video. How to quickly screen for volatility contraction patterns using the MINERVINI trend template criteria. The characteristics of the biggest winning stocks. So what are the characteristics of the stocks that went on huge runs? What are those characteristics? And then guess what? That feeds into the scanning criteria, which I'm going to be teaching you. How to trade volatility contraction patterns and optimizing profits. So I'm going to take you through a couple of things I think about from a trade management standpoint in terms of selling rules and selling guidelines. How to trade cheat and low cheat entries and optimize profits. So these are setups lower in a VCP base. 3 most important fundamentals for growth stocks. So let's start with the price cycle and VCPs. Context, because it's where are you seeing specific things. So let's just start off the 4 stages of the price cycle. Stage 1, neglect phase. So that's going to be consolidation down here. There's actually a really nice VCP that you're going to see in a couple of slides time down here as well. I'll give you a clue. 1 contraction, 2 contraction, 3 contraction. You could also include this as well. Stage 2 is the advancing stage. So that's going to be here where you see a nice uptrend in the stock and all the general indexes as well. Stage 3 is the topping phase where you have distribution coming through in here. Stage 4 is the declining phase. So that is when there would be a downtrend. So you are looking for the market to be in an uptrend, so in a stage 2 advancing phase, and you'd also like your stock to be in a stage 2 advancing phase as well. And that's how the screening type criteria and the trend template helps you as well. So don't worry about trying to understand everything here. There's a couple more slides which will illustrate it for you as well. So remember what I was just saying. Don't worry about all this text right now. Remember what I was just saying about those 4 stages, okay? You basically have the neglect phase where there's a consolidation, you have an advancing phase, you have a distributional topping phase, and then you have a declining phase as well. So the market can only move, and stocks can only move in one of 2 ways. They can move in a non-trending environment, so they're basically just range bound and not going anywhere. So that will be in an accumulation phase. So in terms of a bottom, so stage 1 where it's just consolidating, it can be in a stage 3 topping phase as well, or you can have an uptrending market or a downtrending market, so a trending environment. So non-trending environments and trending environments. So clearly when the market is in an uptrending environment, as you can see by these green areas here, that is going to be the best moments in time, I think, to be trading VCPs. If you look for some other videos on the channel, you'll see a study that I've done looking at 3,000 of these type of breakout setups, and actually the longer term trend of the index was very important indeed. So let me just put a little bit more meat on the proverbial bone. So stage 1 neglect phase, which is the consolidation, transitioning criteria into a stage 2 advancing phase, so an accumulation. So if you imagine this was a stock as well, you could see it as the Dow Jones, obviously, because this is the chart of the Dow Jones, but also think about this as a stock. So these transitions where the price hasn't been going anywhere, it's just range bound, okay, non-trending environment, then those transitions into a stage 2 advancing phase. What are you looking for? Well, you're looking for the share prices above the 150-day moving average and the 200-day moving average. The 150-day, so this is a 30-week moving average, is above the 200-day moving average, being the 40-week moving average. The 200-day moving average is sloping upwards. The share price is generally making higher highs and higher lows, the definition of an uptrend, right? Other notable action to monitor. So this is on that transition as it's coming out. It could be the stock, it could be the major indexes coming out of that transition from stage 1 to stage 2, and that nice powerful uptrend. Larger volume on up weeks and or up candlesticks as well, if you're just looking at a daily chart, relative to volume on down weeks or down days. More up weeks and down weeks, that would also help support higher highs and higher lows. Supportive pullback action, so you're looking for quick recoveries, quick reversals. So as the stock is pulling back in or the index is pulling back in, ideally you would like to see just low volatility, low volume, and respecting certain moving averages. That'll teach you about a little bit later. Preferably price hold holds above and or finds support on key moving averages. And then if you want to go and read this down here and pause the video, from a phase 3 top into a phase 4 or a stage 3 top into a stage 4 declining phase, you can read that. But let's go forward to the next one. So what on earth actually is a VCP? Well, let's just start here with the trend template criteria, because as I said, there's specific moments in time, there's specific areas on the chart where you're looking for this VCP, this volatility contraction pattern to form. So this is the trend template criteria, which I'm going to show you again in maybe 10 or 20 slides time, probably around about 15 actually. And this is then going to feed into the screening, but this is where you're looking for a VCP to form. So you'd like to see that the share price is above both the 150-day and 200-day moving averages. You would like for the 150-day moving average to be above the 200-day moving average. So you can see here, this red line is the 200-day moving average, and this grey line is the 150-day moving average. Note how they are both trending up and also sloping up, and the 150 is above the 200. The 50-day moving average is above both the 150-day and 200-day moving average. So you can see here this purple line, see how it's trending up, and it's above the 150 and it's above the 200. The current share price is at least 25% above its 52-week low. The current share price is within at least 25% of its 52-week high. The IBD relative strength is greater than 70, but preferably in the 90s. I'll show you how to use relative strength when we get into the screening a little bit later on. The current share price is trading above the 50-day moving average, but with an exception within 8% of the 50-day moving average for low cheat and cheat type entry. So it could be just below it, but within 8%. So therefore, we're looking at a stock that's in an uptrend, okay? It's above these key moving averages, and these key moving averages are sloping up. So then what are you actually looking for? So I've done this schematic example here. Invariably in a classic VCP, so volatility contraction pattern, you will see somewhere between 2 to 5 contractions in price. So what is a contraction in price? Well, this is a contraction in price. So for this one here, there's 3 contractions. The first of which is 16%. The stock then rallies. The next one is 8%, and then the next one is 4%. So there's 3 contractions, and the depth of the contractions is around about halving each time. Now, this is kind of a perfect schematic. Is it going to happen that perfectly that it goes from 16% to 8% to 4%, or from 20% to 10% to 5%? It's not going to happen that perfectly, but a good rule of thumb is you would like to see the contractions roughly halving in terms of the depth of the declines each time. It's not going to be that perfect. It's not going to play out like that. Sometimes it may be 2/3 or something like that. Sometimes it may even be a quarter. It really depends, but this is the thing that you're looking for. Ideally, it's building higher lows, and the depth of the contractions, which usually there's 2 to 5 of them, are getting less each time. And I'll give you an analogy in a minute as well. So you can see here, first contraction is 16%, finds supportive action above the 50-day moving average. That's a good sign. It then bounces up here, goes back to the high of the base. I'll explain this in a minute as well from a supply and demand perspective, and then it pulls back down here, and the depth of the next decline is 8%, holds above the 50-day moving average. We have another bounce, and then the final contraction is 4%. This is what you really want to see as well. So somewhere between 2 contractions and 5 contractions, but the final contraction to be in single figures. And there's specific candlesticks you'd like to see the volume drying up. We'll do that more so when we get into detailed examples, just keeping it a little bit broader scale here. But you'd like to see the final contraction in single figures, because number one, it helps to indicate there's not too much supply coming to the market, and number two, it can help create a more asymmetric risk versus reward trade. So these contractions here, you may be going, well, why are they halving roughly each time? What is actually going on from a supply and demand perspective? Well, if you think about it, okay, so if you have a towel and you dip it in a bath water, I don't know why you dip a towel in a bath water, but you put your towel in the bath water, you pick it up, okay, the towel is drenched, there's water just coming off of it, right? If you were to wring that towel, okay, water would fall onto the floor or back into the bathtub. Okay, so think about that first wringing of the towel as a contraction. So each wring of a towel is going to be a contraction in price. Now, what would happen each time, okay, you wring the towel? There's going to be less water coming out of it because you've already wrung out that water. Think about that as supply as well. So as you move from left to right here and you go through 2 to 5 contractions is the norm. Rarely will you see more than 5 contractions. So as you wring out the water, as you bring out that supply, there's going to be less supply that's coming to the market. So this is why you can get the higher lows forming. So you see the low here, and then it goes and puts in a higher low here for the 8% contraction, and then it goes and puts in a higher low here for the 4% contraction. So there's less water that's coming out of that proverbial towel. There's less supply that is coming to the market. That's why you're seeing these higher lows. Ideally, you'd like to see volume drying up, which we don't have on this chart, but we've got lots of examples to go through. Ideally, you'd like to see volume drying up as well, in conjunction with these higher lows forming and the depth of the declines lessening as well, just to all indicate that there's less supply coming to the market. So these VCPs, I'm getting ahead of myself a little bit, but these VCPs, this is a visual representation of supply and demand interacting with each other, and weak hands moving in and accumulating the shares, or sorry, strong hands moving in and accumulating the shares off of weak hands. And this is why it's a timeless principle. And I'll show you a chart of the Dow Jones. This is going back to 1903, 1904. It's the same thing. So you see there's a big decline going on in the indexes here. You could look at this as a contraction as well, but certainly if you look in this region here, okay, there is one clear contraction, two contraction, and then three contraction, and it's round about halving in depth each time. So this would be 1, 2, and then 3, and then look at the tightness coming out. I know we don't have volume, we don't need volume right now, we don't need to confuse it and make things too complicated yet. Just want to train your eye to the VCP, so you can get these in those phase 1 or stage 1 accumulation type bases as well, the consolidation phases. So 1, 2, 3. Look how clear it looks relative to the schematic. But what is going on here from a supply and demand perspective? As price gets over here, there's very little supply that's coming to the market. So price can move very easily through this way. Again, the secret to the stock market lies in being able to interpret supply and demand. That's a Richard Wyckoff quote. Okay, it's absolutely timeless. If we go on to another one as well, before I do that, Jesse Livermore, legendary trader, I absolutely believe that price movement patterns are being repeated. They are recurring patterns that appear over and over with slight variations. This is because the stocks were being driven by humans, and human nature never changes. It's absolutely timeless. So this one here, this is the Dow Jones. We're now 1926, 1927. What do you see? It's in the context of an uptrend. Now there's 4 clear contractions, and the depth of the contractions is around about halving each time. 1 contraction, 2 contractions, 3 contractions, 4 contractions. Don't worry, we'll get on to where is the actual entry point and everything like that a little bit later, but can you see the contractions? Are you starting to train your eye to, okay, 1 contraction, 2 contraction, 3 contraction, 4 contraction, high lows, depth of the contractions are roughly halving each time. It's very constructive. Ideally, you would like to see, this is obviously the index being the Dow Jones, then staying above key moving averages, certainly when it really starts tightening up over here in what we'll call the pivot area as well. Again, we've got lots of examples to be going through, but just want to keep this really easy to follow this video. 1 contraction, 2 contraction, 3 contraction, 4 contraction, higher lows is very, very important, and it's absolutely timeless. And a little side note, if you see the major indexes doing this, that's a very constructive sign. So much as it's very constructive to see a stock exhibiting this behavior, it's very constructive if you see the major indexes exhibiting a large, say, VCP pattern, or potentially a low cheap pattern, but let's just keep it on VCPs for a minute, or potentially a sector, a group, an ETF, a theme ETF. Can be a very constructive sign as well. So it's absolutely timeless, right? So Bitcoin, this is 2012, 2013, again just on the weekly chart here, but 3 clear contractions, a lot of volatility, a lot of supply coming to the market, and then 1 contraction, 2 contraction, 3 contraction. Now we're adding in a little bit of volume here as well, but do you see how visually in terms of the candlesticks, the volatility of the candlesticks lessens as we move from the left hand side over here and we move to the right hand side over here? Do you visually see how the candlesticks, the volatility is high over here, it's kind of okay in the middle, but as we get over here you get very tight candlesticks, and this black line that you see across the volume is the 30-bar average. So do you see how suddenly you get around about 4 very tight candlesticks, and the final 2 before the breakout really starts happening, very tight in terms of the candlesticks, and look how the volume dries up as well. So tightness in price and low volume indicates there's very little supply coming to the market. If we go back to that towel analogy where the towel is really wet, there's hardly any water that's coming out of that towel. So on these bars here, there's hardly any supply that is coming to the market. This is very constructive action to see, and it is not uncommon, and in fact it's very common to see these type of candlesticks before you get a stock breaking out of a VCP pattern or coming out of a cheat or low cheat. So tightness in price, low relative volume is going to be very, very important indeed. So how to screen for VCPs. So I'm going to take you through this, the trend template criteria and the characteristics, the 95% club characteristics. Then I'm going to show you a couple of examples, and then we're going to go into the screening. I'll show you how to very quickly screen for it. So we've already covered the trend template criteria, so I'm not going to read this to you again. The 95% club. So this is the characteristics of the biggest winning stocks. Now this is a bit of a combination between Minervini's work and also Neil's work as well. So the 95% club, okay, 99% of these stocks, so these VCPs, when they went on huge runs and some of the biggest winning stocks in the market, think about the Cisco systems from the late 90s. What did they do? What are some of the repeatable characteristics that we can identify? So 99% of them were above their 200-day moving average. 96% were above their 50-day moving average. 95% had a float under 30 million shares outstanding. 95% showed earnings acceleration. 96% began their big runs from general market corrections or pullback periods. So you know how some people can get all kind of angry and upset when the market's pulling back? I actually see it as a fantastic opportunity. Why? Because fantastic opportunities are going to come out of that. 95% had a growth catalyst, such as a new product, service, or a positive company and or industry change. 70% reported earnings of greater than 20% in the most recent quarter. 80% IPO'd within the previous 10 years. So think about this criteria here, then take a look at some of the setups, and then what we're going to do in a couple of slides time, I will take you across to my custom built stock screener, and I will show you how you can quickly set up a screen for this type of criteria and easily and quickly identify these kind of setups. So IGT, let's keep it a little bit broad brush, and I'll start adding a little bit more complexity and kind of nuances as we go. But IGT here, okay, back in 1988, I've got stock examples covering decades just to illustrate the timeless principle of this. So you can see it's a decent sized base, and it generally speaking starts building higher lows. Now I'm not going to go too depth into the weeds here. I just want you to focus here. Look at the tightness in price. Okay, this is the key to get here. The stock is in a clearly defined uptrend above key moving averages. This is the key for the moving averages here. But look at the tightness in price. Look how the volume dries up before the stock breaks out. Go back to that towel analogy. There's no more water coming out of the towel. Tightness in price like this and low relative volume is very, very key. We're not going to worry about the optimizing profits here. Okay, look at the tightness in price. Look where the stock is setting up. This is the pivot area. Okay, when the share price gets really tight, it's hardly going anywhere. You get the tight candlesticks and the low relative volume. This is the pivot area. Note the repeatable nature of where are you seeing the stock setting up before it breaks out. What moving averages are you seeing it set up on? Are there repeatable moving averages? Are you seeing it, wow, it keeps setting up on the 10 or the 21? That's interesting. Okay, this is then things that then apply to your screening. AN. So you can see here, huge volume coming through. Something happens on this day here, and there's a lot of interest. There's a lot of buying power that comes in. There's a heck of demand that comes in here. Look at the volume. Look at the, I call this bullish synchronicity. Widespread candlestick, gap up, open there low, push up. Look at the volume coming through, and there's a 52-week high on the relative strength line. So if you search my name on TradingView, you will find that Jack Corsellis RS line, I believe it's called. Okay, see these 52-week highs. So the market will not miss the best opportunities. And relative strength, so this is the relative strength line. It's not the RSI, it's the relative strength line. They're two very different things. So the relative strength line hitting 52-week highs, as indicated by these blue dots, is a very, very good sign. Why? Because my belief is the market will not miss the best opportunities, and the best opportunities will exhibit the greatest amount of relative strength. So relative strength, it's not my opinion, it ain't your opinion, it's the opinion of the market. So looking for the highest relative strength stocks, this is why Minervini, when we're looking at the trend template, okay, IBD relative strength greater than 70, preferably in the 90s. Why? Because the market won't miss the best stocks, and the best stocks display the best relative strength. O'Neill did a study, and the average relative strength ranking, the IBD relative strength ranking, I think, was 87 of the market's biggest winning stocks when they were breaking out of basis. So 87, that means it was outperforming, okay, the other, it was in the 87th percentile of stocks it was ranking against as it was breaking out. So it was already showing a lot of performance versus its peers. So you can see here, again, just dial in the pattern recognition, okay? 1 contraction, 2 contraction, 3 contraction, and then it gets really, really tight. Look how the volume dries up, and look again, this black line and this blue line, the 10 EMA and the 21 EMA. Interesting, tightness and price, low relative volume, no more towel in terms, well, there is maybe a towel, no more water coming out of the proverbial towel. Let's do another one here and we'll go on to a little bit of the optimizing profits again. So here we go, we have some clear contractions in price. So the stock is in a powerful uptrend here, tops out here, this is what I call a supply shoot, pulls back down, so you have one contraction, you kind of get two in here, then the next one is an undercut, and you see it's actually a little what I call a shakeout demand tail. It actually undercuts the prior low. These shakeout demand tails, constructive to see, and then it bounces and then it puts in this higher low in here, and look at the tightness in price. This is a textbook example. Look at the tightness, look how the volume dries up, look at price when it's tightening in relation to these key moving averages. Where is it happening? What are you seeing on a repeatable basis? Then what I'm indicating here is I like to look for, these are what I call trigger bars. They're really tight bars, low relative volume as well, sitting on one or more key moving averages. This is where the risk versus reward can really make sense. If you want detailed videos on risk versus reward, search MINERVINI on the channel and you'll find some more recent videos where it goes really far in terms of the risk versus reward and all of that good stuff. I want to keep this one a little bit more broader brush, but look at the tightness in price. Then if you're thinking about optimizing profits, for me, I like using the black line being the 10-day EMA and the blue line being the 21-day EMA. For some stocks, I may use the 50-day moving average as well. Now I'm using those as trailing stops once I have free rolled the position. If you want to learn about free rolling, cover it on other videos on the channel, but these are then the moving averages that I'm using to help capture the intermediate term trend. For me, I'm an intermediate term trend follower. So I like using the 10-day EMA, the 21-day EMA, and the 50-day simple moving average. Maybe it's one of those, maybe it's a combination of those. If I think price gets extended, I will choke off some or all of the position, depends on the action. But I'm trying to sit and ride these moving averages like this. Let's do another one. This is BHC. So this is more of a cup and handle type pattern, okay? So a volatility contraction pattern is a characteristic. So volatility contracting is a characteristic you're going to see numerous times in other bases. So this is a cup and handle, okay? Here's the cup. Here's the handle. Now note how you get these shakeout demand tails off of the 21-day EMA. Very constructive sign. Bullish reversal bar coming through here, and then in the handle, which will commonly look like a Davis box as well, or a little VCP and a cup and handle. Okay, you see the tightness in price, and then you get that really tight bar, inside bar, sitting on the 10-day EMA. Interesting. The volume dries up. Now I'm just going to touch on relative strength again. Can you see that you get these blue dots coming through on the relative strength line, and the stock is still within the base? It's actually carving out a handle in here, but it's getting these 52-week highs. This is one of the strongest signs of strength a stock can possibly give, in my view. 52-week highs, and the stock is still within its base. Now, why is this? Think of that basketball being held underneath water. This stock at the minute is a basketball being held underneath water. It could be that the indexes are correcting or the group is correcting, and it's just not letting this stock go. That water is just keeping force on the basketball. But once that pressure is released, what's the basketball going to do? It's going to pop out of the water. So 52-week highs as a stock is still basing, I think, is one of the strongest sign strengths a stock can possibly give you. And then note the trends as well. So I've kept the chart on to show you closes below the black line, closes below the blue line, closes below the purple line, being the 10, the 21 and the 50, because it's important to not only think about the VCP and how they set up and cheats and low cheats, but I think it's also important to then think about things from a trade management standpoint. So there's 4 distinct parts to every single trade. Number one, you got to identify it, which we're putting a heavy emphasis on this video. That's really where we're focused on identify. Number 2 is control it, and I'm giving you an indication of how I think about controlling it, looking for these nice tight bars, get the risk nice and tight. Number 3 is risk mitigation, which we're not covering in this video, that's in other videos. And number 4 is optimizing profits. So you then got to look at, well, what happens afterwards? What happens after these VCPs entries, these cheat and these low cheat entries? What does the stock do? What do the best ones do? Are they riding their 10? Are they riding their 21? Are they riding their 50? Are they riding their 200? What's optimal? What do you think is optimal? And that's where the study comes in and the deliberate nature. So for me, as I said, I like using the 10 and the 21. For me, that's the shorter and intermediate term trend. I would consider the 50-day moving average to be the longer term trend as well. If you go and watch some of the recent videos, it'll show you some of the data from that as well. So Cyrus logic here, slightly different in terms of how it looks, but you have one contraction here, bounce, 2 contraction. This would actually be a low cheat entry, which you're going to learn about shortly. And then you have this final contraction over here. So you have 1, you have 2, and then you have 3. And then actually in this final contraction, you could look at this as a cup and handle type pattern. In this final contraction, you actually have a mini VCP. So due to the fractal nature of the market, which basically means patterns form form within patterns, you'll get these patterns forming within patterns. So in the context of this larger pattern, you have 1 contraction, 2 contraction, 3 contraction. Then you get the tightness in price, the volume drying up. And what do you notice? Where is this tightness in price happening? What moving averages is it sitting on? Again, 10-day EMA, 21-day EMA is not far away either. And then how does the stock move? That's what you really want to be training your pattern recognition to. FDX, so FedEx. Okay, gaps up on the earnings, gap up, not a great candlestick though, but then you have 3 clear contractions. You have 1, you have 2, you have 3 higher lows, and then look at the tightness in price. That 10-day EMA is showing up again. 10-day EMA showing up again, tightness in price. Look how the volume dries up below the 30-bar average. Isn't that interesting? So what is happening on a consistent basis? And then what happens afterwards? What moving average is a stock trending before it closes below? Can you use that in terms of your trade management? So again, that's thinking about the 4th part of a trade, optimizing profits. So that's why I'm saying 10 EMA, 21 EMA. For me, I would consider the 50-day moving average to be the longer term trend. 30 years ago, maybe you'd say it was the 200, but the market keeps moving quicker and quicker. Let's do a couple of more and then I'll take you into the screening. So this is Pantheon Resources UK stock. So you can see the demand coming through. This is really good. Pre-base, you can see the demand visually coming through. Look at the price acceleration, look at the large volume, look at the 52-week highs on the relative strength, really good. Now the stock pulls in, finds supportive action on its 21-day EMA. That's a very constructive sign. So then you have a 1 contraction, 2 contraction. Look at the tightness here. This would be a cheat, low cheat entry given the tightness in price. Don't worry, you're going to learn about that in about 10 minutes time. Look how the volume dries up, and then you get this tight bar. It's nearly an inside bar, so tight bar sitting on the 10-day EMA. Look how the volume dries up before the stock starts coming out of the base. And then what moving averages is the stock respecting? This all feeds into the trade management side of things. Canopy growth, I'll show you how to scan after this one. Okay, so look at this here. 1 contraction, 2 contraction, 3 contraction. So remember the wet towel. As you get over here and you've had clear 1, 2, 3 contractions, look how the volume starts drying up. Look at the tightness in price. Where is price setting up? This is called the pivot when you get these multiple tight candlesticks sitting on 1 or more key moving averages. Where is the pivot forming on a consistent basis? What are you seeing? What are you seeing in terms of the repeatable nature of this? Okay, so look at this here. Tight price action, volume dry up, you get 52-week highs pre-base, 52-week highs very soon after the stock is coming out. And then what's the optimal way to be managing the position? Is it just to sell it 2 days later, 3 days later, or is it to try and sit and ride intermediate term trends? Interesting, right? So what we're going to do now is we'll quickly jump across to my custom built screener, and I will show you how to use my screener to identify these type of setups. We're on my custom built stock screener that we call Stock Screen here. We have free plans and paid plans available. Currently, within the free plans, we're offering you this. So you get various exchanges, Australia, Canada, India, UK, and US, and you get these preset screens as well. So for the US, we have various different ones like a can slim screen, a high tight flag screen, a volatility contraction pattern screen. So if you're interested in having a play around with that, head over to my website. And at the moment, we offer a free plan, so you can go and play around with some of these. If you want to create your own screen, then I can show you how to do that. So I'm going to go US trend template like this. So country US, and I want the price to be above the 50-day moving average. I want price to be above the 200-day moving average. Why? Because trend template, I want it to be in a stage 2 uptrend. Price within 25% of its 52-week high. I want the 50-day average volume to be greater than 50k. I could increase that but to 100k, 200k. Again, just trying to get out some of the very illiquid stocks in the market. And the relative strength rank, I actually want the 3-month relative strength rank because I think that's better to use than the 12-month. I think it's more efficient for finding these type of setups to be greater than 70. So let's hit search there, okay? Now in our database, we have around about 5,500 stocks. So we've taken that 5,500 stocks down to 374 stocks meet this criteria. If we wanted to add a little bit more in terms of the criteria, sure, we can go and do that. If we wanted to add, say, an earnings or a sales in, we could come in here, we could click growth. I could put an EPS percentage change year over year. So that would be for the earnings. If I wanted to put a sales marker in there as well, so sales change year over year basis, I could put that in. I could put it at 10%, 50%, 100%, whatever I want to do, right? But I'm just going to keep this a little bit broad brush here and show you some of the results and how quick this is. Okay, so what I like to do is we've got the results here. Now this is sorting it by market caps. You can see Google, Meta, Costco, Amgen are coming to the top at this moment in time. I like to come over here and I like to filter via 3-month relative strength to find these type of continuation based setups, so like the VCPs, the high tide flags of the world, the cup and handles. I like to look for relative strength 3-month. Remember what I said earlier, that for me the market won't miss the best opportunities. The best opportunities will exhibit the highest relative strength. So I want to have these 99 RS stocks to the top. These are the ones that I want to look at first, and 3-month I think is the most efficient way to do that. So I'm going to come across here, okay? Now we could hit flex charts and that will show you the chart and it will show you the earnings and sales data side by side. But for the purpose of this, I'm just going to hit charts. And remember, we're looking at the strongest stocks on a 3-month relative strength basis first. If you want to have 2 charts per row, you can do that. You just go into the settings and change it. The moving average you see is going to be the 21-day. And I'm just going to be scanning through. And here we go, VRT. Already stocks building a sizable base. I know because I'm looking at 3-month relative strength, I know that this stock is going to have a very high 3-month relative strength because I've just filtered by that. So what I like to do is use things like the trend template, so cast a relatively wide net for stocks in uptrend, but then filter those results by relative strength rankings. I think that's very key. So VRT, see how it's building this base here. This is the 21-day, so kind of ebbing and flowing. This is one I want to have on a watch list. So what I can do here is click here, go down, and I can put it into my watch list. It's currently in my watch list. It's in the True Market Leader watch list at, well, VRT at this moment in time. I can then import that watch list into TradingView and TC2000. I just go your area into the watch list, then import it in. If I want to go directly into a TradingView, then I can literally just click here, view TradingView chart. If you have a TradingView subscription, it'll load it up with your chart. So nice and easy to do the scanning. Let's see if we can quickly find a couple of others. Next one is ERIE. Looks pretty interesting, doesn't it? Around $300. Okay, kind of tightening up, needs maybe a little bit more work. MMYT, see how this stock here, decent sized base, just pulling in. Look at the tightness, that's actually an inside bar coming through in there. Stock's building a nice base. So yeah, maybe I want to put this in the watch list. Maybe I want to go back to this stock here, put that one in a watch list, and it's literally that easy, that quick to do as well. So I'd encourage you to go and test it out, have a play around with it. This one here, this is AHG, only $1 stock, but really nice chart pattern, but too liquid for me, and only $1 stock as well. So yeah, guys, it is literally that easy to go and use the trend template criteria on stocks in here. So go and give it a whirl and see what you think. And like magic, we'll now go back into the presentation. Okay, we are back, and let's just get straight back into it. So OST, okay, this one I bought on this day here, coming through. So 1 contraction, 2 contraction, 3 contraction. See how the volume just stair steps down here. So powerful uptrends. Remember what we've just been doing from the trend template criteria. So you're screening for those stocks that exhibit this type of behavior. So the screening criteria is specifically focused and designed to find these type of setups. Okay, that's what it's doing. Quickly and efficiently find these type of setups, and then I go look at it. I do a little bit more research on the fundamentals, plan the trade out. Do I think the risk makes sense? Is it a leading stock? Yada yada yada, right? So you can see the powerful nature of the uptrend here, and getting a couple of these right a year. This stock goes from $22 before it closes below it's 21, goes up to about $90. Getting a couple of these right a year, really, really key. PRTS, in terms of a high type flag and a VCP, in terms of a high type flag, first and foremost, this is probably as textbook as you are possibly going to see. The stock goes from $2 up to about $10 or so, and then see how it holds its 10-day EMA. So let's just go into the EMAs a little bit. What you'd like to see pre-base, so before a VCP or a high type flag, MINERVINI calls it a power play in his books. Well, I don't know, it's a high type flag to me. But see how it's in the context of an uptrend here. See how the stock is not chopping around all over the place. It's not chopping through these moving averages and kind of grinding high. It's just a really nice, smooth, clean trend to the upside. That's important from a trade management standpoint. Why? Because for me, as I said earlier, I'm looking to use the 10-day, the 21-day, maybe the 50-day as well. And the best indication of how a stock is going to move in the future is how did it move in the past. So I'm looking pre-base for the trend pre-base. I'm looking back at previous breakouts that stocks may have had, and how did it move from the breakouts? What was the behavior it exhibited? Because that could give me a tip off to I don't want to go anywhere near this stock because it's just chopping around all over the place and it's going to be a nightmare to manage. Or it might be, well, this stock loves riding its 10-day, or it loves riding its 21-day, or actually maybe it's a commodity stock, maybe it's a bigger stock, a bit slower stock. So actually the 50-day moving average is potentially going to be better for that type of stock. But you gain that by looking at how does the stock move, what's the previous behavior of the stock. I think it's really key. Then as the stock starts basing, okay, the strongest stocks will respect their 10-day EMA. So see this black line here? See how it bounces here, bounces here, bounces here, tightens up on its 10-day. The strongest stocks will do that. Okay, the very strong stocks as well will also respect their 21-day. So for these VCP type bases, if it's more so continuation bases, base duration somewhere between 3 weeks to 12 weeks, I think the most important moving averages to be focused on are the 10-day EMA, the 21-day EMA. Bit of a bigger base, bring the 50-day moving average into it as well. But look at the tightness, look at the volume drying up, look at the 52-week highs. The market won't miss the best opportunities. GameStop as well. So this is the last VCP before we go into the cheat and low cheats. So how many contractions do you see in the base? And this stock then goes from $5 over to over $100, okay? 1 contraction, 2 contraction, 3 contraction. Look at the tightness and price. Look how the volume dries up. Look at the 52-week highs. So if you're scanning for 3-month relative strength, GameStop's going to come up on your radar. Okay, it's going to come up on your radar because look at the relative strength, look at the 52-week highs. The market does not miss the best opportunities. So let's go into the VCP cheat and low cheat. So volatility contraction pattern, cheat and low cheat type entry. So this is just variations of the setup, and quite often you can get low cheat and cheats forming in the likes of cup and handles. So remember what I said earlier, that VCP in terms of volatility contraction, it's a characteristic you'll see in other bases. That could be a high tide flag, as you just saw on PRTS. It could be on a cup and handle type pattern. So the definition of a low cheat is that the setup where the tightness is coming through is forming in the lower third of the base. So the lower third of the potential cup and handle type pattern, as we're showing here. A cheat would be in the mid third, and then the upper third would be kind of your traditional handle as well. But you can get cheats and low cheats in VCP setups, high tide flag setups, Darvis boxes, pennants, wedges are quite common to get lower entries. You're going to see one for Novavax, I think, that's more of a cheat type entry. So the point of a VCP is to create a low risk repeatable entry point with asymmetric risk versus reward potential, and you have an idea of what should happen next for normal and abnormal behavior. That's why I was showing you what happens after. How does the stock trend? So you can start to learn and identify, okay, this is acting normally, this is acting abnormally. The VCP is a pattern, it's usually an ascending triangle in and of its own right, but volatility contraction is an optimal characteristic to identify in other chart patterns, such as a cup with handle. Also, when you get the real tightness in price, it can help create a more asymmetric risk versus reward trade. So the whole kind of point in trading is you're trying to risk $1 to make $5, $10, $20, right? So AXDX, this is back in 1996, okay? So you have a VCP here, okay? Stock is in an uptrend, some 52-week highs coming through on the relative strength line, then you have a 1 contraction, 2 contraction, 3 contraction. Look at the tightness in price and see how this here is basically a little Darvis box, a little rectangle, okay? Tightness in price, low relative volume, tells you what about supply coming to the market. Remember that tau? There's not much water coming out of that tau, but the higher the base is up here. So this is what I've done on these examples here. The higher the base is up here, near $110. That's going to be what, around $105 or so. That's not the entry point. The entry point is down here, and this is Livermore's point about continuation pivotal points. You're looking for where the stock basically gets dull, where there's kind of little volume coming through, there's little range in terms of what price is doing. So there's little volatility, there's little range. So volatility contraction. This is where the volatility is contracting in terms of the price. This is where the volume is drying up. The entry is down here. The entry is not up here. Quite common to see. eBay as well, okay? The entry is not up here at the highs of the base. This is very V-shaped in nature. The entry is here. You get this tight inside bar, and note the clustering of the 10, 21, and 50 SMA. So eBay starts building higher lows, and then this is where the tightness comes through. This is where the volume dries up. This is where supply stops coming to market. So the expectation is price should move very quickly through this level. So the entry is not up here at the high of the base. It'd be very difficult to get a really nice tight stop there. The entry is down here. Okay, SLS, this is a ridiculously good one to illustrate. 1 contraction, 2 contraction, 3 contraction. Remember what I said about strong stocks will find support on their 21-day EMA. Then look at the tightness coming through here. Tight inside bar sitting on what moving average? 10-day EMA, and look how the volume, it's maybe a quarter versus the 30-bar average. What is this bar telling you about how much supply is coming to the market? There's not a lot of supply coming to the market. There's very little. So the entry is not up here through the high of the base. That's not the entry point. The entry point is here. Okay, this is where you can get a really tight asymmetric risk versus reward trade. ACB as well, cannabis stock. 1 contraction, 2 contraction, 3 contraction, tight inside bar sitting on what moving average? 10-day EMA. Look how the volume dries up, and see how the volume has just been drying up from left to right. Look at all the demand coming in pre-base. So remember what I was saying earlier about the previous behavior of the stock. How did it trend pre-base? Stayed above these moving averages. That's really good when you think about it from a risk versus reward, well, sorry, from a trade management standpoint, and fourth part of a trade, optimizing profits. Really good trend. Look at the 52-week highs as well, and then you get this tight inside bar. That's where the risk versus reward can be ridiculously good. Now it powers out here from $66 over a double in, what's that, around about 2 weeks to $140. So yes, you can be thinking about using the 10-day EMA and the 21-day EMA, but remember what I said about understanding the previous behavior of the stock, and this is focused on fourth part of the trade, optimizing profits, is if a stock gets extended and the stock's gone from $66 to $140 in 1, 2, 3, 4, 5, 6, 7, 8 candlesticks, okay? I will invariably move my stop loss on all or part of the position. If I think it is climactic and extended from the 10-day EMA, I will adjust my stop loss to the lower the bar. So on this day here, maybe I'm thinking, oh, it's extended. I'm going to move my stop loss on all or part of the position to lower this bar here. And then it goes up again. I'm going to move my stop loss to the lower the bar. Now, if you look back previously, well, this got pretty extended here. So if on this day here, I go, it's extended, do I just sell it? Is that optimal? To just go, well, I'm up a lot here. I'm just gonna, is it optimal? Is it not optimal? So here, lower the day, lower the day, lower the day, lower the day. Choke it off that way. That's an effective selling strategy that I use instead of waiting for closes below, say, the 50-day moving average or the 21 or the 10. Okay, think about the stocks you're trading. ALT as well. So the entry is not up here. Okay, the entry is not up here at around about, what's that, around about $4.50. Okay, the entry is not here. Look at where the tightness and price is coming through. 10, 21 and 50 clustered like that. That's really nice. Look how the volume dries out. You get kind of one big contraction here and then two and then three, and look how tight the stock is getting here. This is really, really good behavior to see. Tightness and price, low relative volume, tells you what about supply? There ain't much supply. And these tight bars here, like Novavax, tight inside bar, low relative volume, helps create more asymmetric risk versus reward trade. So this here is more of a wedge type pattern, but if you're using the MINERVINI vernacular, you could call it a cheat, low cheat type entry. So you get, look at the demand coming in pre-base, look at the volume coming through, look at the positive price appreciation, look at the 52-week highs, and then it pulls back down. Strong stocks will find support on what moving average? 21. So see, shake out demand tail here, shake out demand tail here. Then you get this tight inside bar. Look how the volume dries up, and the volume is just dried up from left to right. And then see how the stock moves there afterwards. It's really important not to just study the bases and the setups, but to really study what happens afterwards. Like the trade management is absolutely key. The optimizing profits is key. Getting the bigger ones right is key in my view. So let's go on to key fundamentals for growth stocks. So what are the three things that I really focus on? I would also add estimates to this as well if I was to chuck in a fourth. But the three most important fundamentals for growth stocks is earnings, sales. How can a company increase their sales? Well, they can raise prices, which then also feeds into the earnings, or sell more units of existing or new products. After tax net margins, they could raise prices, they could cut costs of goods sold, they could improve productivity, they could remove losing inefficient operations. So when I'm looking at a company and I'm thinking about the fundamentals, I want to see earnings improving, sales improving, margins improving, and ideally estimates that are going into all-time high territory as well, which I'll show you on the final slide because we've got one more after this. So when technical action and fundamentals line up, it can create amazing trends. So this is Monster Beverage, okay? So many of you would have heard of their drinks, maybe you drunk their drinks as well. So energy drinks, you often see them in supermarkets, petrol stations, and all of that stuff, convenience stores as well, okay? So Monster Beverage, this is the early noughties bear market, okay? So here's 2000 to 2003. This is the monthly chart, okay? So you actually get a VCP, and again, it's timeless. You'll see it across all durations, and you actually get this tight trigger bar sitting on the monthly 10 EMA. It's very hard to see, but very low relative volume. So this tight inside monthly bar. Remember what I've been blabbering on about tight inside bars that I call trigger bars on those daily chart setups we were just going through. Here it is on the monthly as well. So you get a VCP. So this is a concept as well of the law of cause and effect. Invariably, the bigger the causality, so the bigger the base, the bigger the trend. That could be both to the upside and also to the downside as well. This is a very big base on the monthly chart. This is a multi-year base. So a lot of accumulation can go on. Strong hands can move in, they can accumulate shares off of weak hands. But see how Monster Beverage here, before it trends up 9,000% nearly, see how it's hitting 52-week highs in the base. What did I say earlier on about a stock hitting 52-week highs in the base is one of the strongest signs of strength you can possibly see. And as I said earlier as well, that relative strength, it's not my opinion, it's not your opinion, it's the opinion of the market, and the market won't miss the best opportunities. That's just my belief. It won't miss the best opportunities, and the best opportunities will exhibit the best relative strength. So here's Monster Beverage in the base hitting 52-week highs, and it's building a VCP on the monthly chart, and you get these nice shake out demand tails, and then you basically get 1, 2, 3, 4 months are nearly inside bars in a row. That's extremely, extremely rare. So in training your pattern recognition tool, wow, that is really rare. This is setting up absolutely perfectly. You have to know what that looks like. Like Monster Beverage here, this is nuts. This is ridiculous. So that's from a technical standpoint. We haven't even touched on the fundamentals yet. So let's touch on the fundamentals. When 2003, the earnings per share for that year was 75%. The sales were up 20%. Net profit margins accelerated from 3.3% to 5.4%. Okay, not bad. 2004, EPS goes up to 214%, year-over-year sales go up to 63%, net profit margins nearly double, over double, from 5.4% to 11.3%. Wow. 2005, earnings per share up 195%, sales up 93%, net profit margins accelerate again from 11.3% to 18%. So it's not just technical action. Bringing in the fundamentals as well. Technical action is obviously very, very, very important, but if you get fundamentals like this as well, and have a very powerful situation on your hand. So just to finish off with the final slide, this Market Smith slide here. So just to illustrate the point. So this is VRT, which I think I showed you in the screening earlier, okay? VRT, if we take a look at it, okay? we can see that the earnings are accelerating. So plus 15%, plus 600%, plus 400%, plus 360%. We've got the sales accelerating as well. 21%, plus 17%, 32%, 24%. We take a look at the after-tax margins down here on the bottom, going from 5.8% to 6.5% to 6% to 10.1%. We've got 2 high quality funds invested. We've got a really strong RS line. The stock is displaying a fantastic relative strength. 99, it couldn't be any higher. It's generally speaking staying above key moving averages, being the 21, being the 50 as well, being this red line in here. Look at the estimates for this year and next year. This year, 203% with the guidance up. 2024, 24% with the guidance up. And it's a little subtlety here. Do you see how the earnings per share estimates are going into all-time high territory? Really like that. So I think that's a little subtlety. So you know that triangle that we were looking at? I think you could put in the middle here EPS estimates into all-time high territory. That there is nice to see. I think that's nice with the guidance up as indicated by that green arrow. So that's it, guys. I will wrap the video up there. Hopefully that video has been helpful to you in terms of learning about volatility contraction patterns, but also bringing in some of the fundamentals of what do these excellent stocks display from a fundamental perspective, also from a technical perspective. So if you're new to the channel, please do consider subscribing for more videos like this. Really helps me out if you like the video, and I look forward to seeing you in a future